Today, we're putting a classic economic theory to the test. It's one that has guided policymakers for decades. We're talking about the Phillips curve, but not in some dusty old textbook. Nope. We're going to see how it holds up in the real-world, dynamic economy of Malaysia over the last 20-something years.
All right, so let's dive right in. We'll start with the elegant promise of what, on the surface, seems like a really simple, almost intuitive economic rule. Just imagine for a second that you're in charge of a country's economy. This is the choice you're facing, pretty much every single day. Do you focus on tackling rising prices, what we call inflation, or do you focus on rising unemployment? For a long time, economists thought you could only fix one by making the other worse. And that trade-off? Well, that's exactly what the Phillips curve is all about.
At its core, the idea is actually pretty simple. The Phillips curve suggests that there's this inverse relationship between inflation and unemployment. The best way to think about it is like a seesaw. When one side, say unemployment, goes down, the other side, inflation, is supposed to go up, and vice versa. Pretty straightforward, right?
And, the logic behind it makes a lot of sense. When unemployment is really low, it means most people have jobs. That forces companies to compete for workers, and they usually do that by offering higher wages. But then, to cover those higher wage costs, the companies have to raise the prices of their products and services, and boom, you get inflation.
So here it is, the multi-trillion-dollar question for governments and central banks all over the world. Does this neat and tidy little theory actually work in the messy, complicated global economy of the 21st century?
So to figure that out, we're stepping out of the textbook and into a real-world test lab. Let's see how the Phillips curve actually holds up when we look at the Malaysian economy.
Now, Malaysia's economy has been on a roller coaster ride, is putting it mildly. First, you have the recovery period after the Asian financial crisis, then bam, the huge shock of the 2008 global financial crisis hits. That was followed by a pretty good decade of steady growth, only to be totally upended by the COVID-19 pandemic in 2020. All these huge events, they're the perfect stress test for our economic seesaw. So, with all that turbulence in mind, what happens when researchers actually take the numbers, the real inflation and unemployment data from Malaysia, and plot them on a graph? Let's take a look. Okay, don't let the math here scare you off. This is just the equation the study came up with. The only thing you really need to notice is that little minus sign right there in front of the 1.24. That negative sign confirms it. Just like the theory predicts, there is an inverse relationship. When unemployment goes up, inflation tends to go down. So check, the relationship exists.
But, and this is a huge but, how strong is that relationship? Well, this number, 16.6%, tells the real story. What it means is that changes in unemployment can only explain about 16.5% of the changes in inflation. To put it simply, that's not very much. The connection is really weak.
And this chart shows you exactly what that weakness looks like in the real world. This is Malaysia's actual Phillips curve plotted out. See how the dots are kind of scattered all over the place? That makes the trend line really flat. It's not the steep, obvious seesaw the theory would lead you to believe. This flattening just means that even a really big change in unemployment doesn't cause a very big change in inflation.
So, here's the bottom line from all that data. Yes, technically, the trade-off does exist. The ghost of the Phillips curve is there in Malaysia, but it's so faint, so weak, it's really more of a whisper than a rule.
And that leads us to the big question, why? Why is this relationship so fragile? Well, the answer seems to be these huge economic shocks that can just come in and completely overwhelm that delicate little balance.
Take the 2008 global financial crisis, for example. Inflation in Malaysia spiked, but it wasn't because the job market was hot. Not at all. It was driven by these powerful forces from completely outside the country. Global prices for things like oil and food just shot through the roof, and that pushed up prices for everyone in Malaysia, no matter what was happening with local jobs. But honestly, the COVID-19 pandemic in 2020 was the ultimate rule breaker. The economic seesaw didn't just flatten, it completely snapped in half. On one side, unemployment surged because of all the lockdowns. Now, according to the rule, inflation should have cratered, but it didn't. Instead, because global supply chains were in chaos, prices actually started to rise. Both ends of the seesaw went up at the same time.
So what this all reveals is that this simple little domestic seesaw is constantly being shoved around by much bigger, more powerful global forces. Things like the price of oil on the world market, the value of Malaysia's currency, government policies like fuel subsidies, and these major supply shocks. These factors are often way more important for inflation than the local unemployment rate is.
So the relationship isn't just flat, it's also really unstable.
And to truly wrap our heads around that, we need to stop thinking about it as a simple line on a 2D chart. We need to picture a reality that's constantly moving.
So let's try a whole new way of looking at this. The source material suggests we should just forget about the Phillips curve as a flat drawing. Instead, try to imagine it as this dynamic, shifting, three-dimensional ribbon that's constantly changing its shape in the wind.
Now check this out. What's so cool about this slide are these incredible 3D models from the source report. They help us see the curve not as a fixed line, but as a surface that actually twists and rotates and even lifts up and down over time. Every big event, like the 2008 crisis or the pandemic, doesn't just move a dot along the curve, it actually warps the entire ribbon itself. It's not a fixed seesaw, it's more like that ribbon twisting in the economic winds.
So, what's the final verdict on all this? Well, the Phillips curve isn't necessarily wrong, it's just incomplete. It's like a single instrument trying to be heard in a massive orchestra of powerful global forces. It's just too simple a tool for the incredibly complex world we live in today.
And the implications of this are huge. It means policymakers can't just pull one lever labeled unemployment and expect to control inflation. They need a much bigger dashboard, one that's constantly tracking global prices and currency values. It means they need to focus on making the labor market work better, and most importantly, they have to build policies that are flexible enough to handle whatever unpredictable global shock comes next.
Which leaves us with this one final, really important question. If the old, simple economic rules of thumb are breaking down, what new tools, what new ways of thinking will it take to successfully steer a modern, open economy through this incredibly interconnected and uncertain world?